Welcome to this lesson on understanding bookkeeping. Bookkeeping is a fundamental requirement for businesses of all sizes, and a key aspect of the accounting function. For a manager, understanding the principles of bookkeeping will help you in interpreting accounts, and in leading the administration of the business. So let's get started. Bookkeeping involves the recording, on a daily basis, of a company's financial transactions. With proper bookkeeping, companies are able to track all information on its books, to make key operating, investing, and financing decisions. In this unit, you will learn about the core principles of bookkeeping. Common financial transactions and tasks that are involved in bookkeeping include billing for goods sold or services provided to clients, recording receipts from customers, verifying and recording invoices from suppliers, paying suppliers, processing employees' pay and the related governmental reports, monitoring individual accounts receivable, recording depreciation and other adjusting entries, and finally, providing financial reports. Today bookkeeping is done with the use of computer software. For example, QuickBooks from Intuit is a low-cost bookkeeping and accounting software package that is widely used by small businesses around the world. Bookkeeping requires knowledge of debits and credits, and a basic understanding of financial accounting, which includes the balance sheet and income statement. Accountancy and bookkeeping are related terms. The former relates to the theoretical study and the latter refers to the practical work. Bookkeepers are individuals who manage all financial data for companies. Without bookkeepers, companies would not be aware of their current financial position, as well as the transactions that occur within the company. Accurate bookkeeping is also crucial to external users, which include investors, financial institutions, or the government, that need access to reliable information to make better investment or lending decisions. Simply put, the entire economy relies on accurate and reliable bookkeeping, for both internal and external users. Although they seem to be very similar, there are some striking differences between the two. To resolve this confusion, we have listed accounting versus bookkeeping differences here. Take some time to examine these differences in your learning manual. There are some common methods of bookkeeping, such as the single-entry bookkeeping system and the double-entry bookkeeping system. But while these systems may be seen as real bookkeeping, any process that involves the recording of financial transactions is a bookkeeping process. There are some common methods of bookkeeping: the single-entry bookkeeping system and the double-entry bookkeeping system. But while these systems may be seen as real bookkeeping, any process that involves the recording of financial transactions is a bookkeeping process. Single-entry bookkeeping uses only income and expense accounts, recorded primarily in a revenue and expense journal. Single-entry bookkeeping is adequate for many small businesses. Double-entry bookkeeping requires posting or recording each transaction twice, using debits and credits. Here are some key features of single-entry bookkeeping. The single-entry system of record-keeping does not include equal debits and credits to the balance sheet and income statement accounts. A single-entry accounting system is not self-balancing. Mathematical errors in the account totals are thus common. A single-entry system may consist only of transactions posted in a notebook, daybook, or journal. However, it may include a complete set of journals and a ledger providing accounts for all important items. A single-entry system for a small business might include a business checkbook, check disbursements journal or register, daily or monthly summaries of cash receipts, a depreciation schedule, employee wages records, and ledgers showing debtor and creditor balances. Single-entry systems are usually inadequate, except where operations are especially simple and the volume of activity is low. Here is an example of a single-entry system. This simple example distinguishes sales ledger entries, confirmed orders, cash sales and other receipts. In the double-entry accounting system, each accounting entry records related pairs of financial transactions for asset, liability, income, expense, or capital accounts. Recording of a debit amount to one account and an equal credit amount to another account results in total debits being equal to total credits for all accounts in the general ledger. If the accounting entries are recorded without error, the aggregate balance of all accounts having positive balances will be equal to the aggregate balance of all accounts having negative balances. This diagram illustrates the mirror image concept, which underpins the double entry system. In addition, the balance sheet ensures that liabilities and assets are always in balance, and that the income statement always reflects the double entry system. Here is an example of the double entry bookkeeping. Lots of Fun Limited purchased a car for $5,000 using a loan from the bank. The two effects are: Lots of Fun Proprietary Limited acquires an asset worth $5,000, the car. This is the debit effect. At the same time, it also incurs a liability to the bank of $5,000, the bank loan. This is the credit effect. There are three basic sets of books, or ledgers, which companies use in recording transactions. The sales ledger, which deals mostly with the accounts receivable account. This ledger consists of the financial transactions made by customers to the business. The purchase ledger, which goes hand in hand with the accounts payable account. This is the purchasing transaction a company does. And the general ledger, representing the original 5 main accounts: assets, liabilities, equity, income, and expenses. The general ledger is the one most managers will need to understand. You might think of the general ledger as a large, old-fashioned scale that is always kept in balance, because its keepers always add or subtract an equal and offsetting amount of weight to each side whenever they record something. All of the buckets that appear in the chart of accounts are arranged in one or the other of the trays, depending on the account number on the bucket. As each transaction occurs and is recognized, the accountants refer to the chart of accounts to find the name and location of the correct bucket or buckets. Then they add to each bucket the appropriate data that represents the financial effect of that transaction. When they add something to a bucket on the asset side, such as a new delivery truck, they must finish the job in one of two ways to rebalance the scale. Here is an example of an extract from a general ledger. Notice that the entries in each of the account codes are both credited and debited. Another financial tool you will often hear of is the chart of accounts. A chart of accounts is a systematic listing of all ledger account names and associated numbers used by a company, arranged in the order in which they normally appear in financial statements. These are customarily assets, liabilities, owner's equity or stockholders' equity, revenue, and expenses. Different types of businesses will have different accounts. For example, to report the cost of goods sold, a manufacturing business will have accounts for its various manufacturing costs. A retailer, on the other hand, will have accounts for the purchase of its stock. Many industry associations publish recommended charts of accounts for their industries, in order to standardize reporting and comparison of companies in their industry. Accounting software packages often come with a selection of accounts to choose for the business. A typical classification of accounts in the general ledger includes the following: asset accounts, including current assets, fixed assets, and other assets; liability accounts, which includes current liabilities and long-term liabilities; equity accounts; revenue accounts; costs of goods sold accounts; and finally expenses accounts. Let's take a quick look at these extracts from a chart of accounts, to give you a quick idea what it might look like in a typical company. Notice that there is a numbering convention, used to help accountants identify assets from liabilities, and income from expenses. There are many schemes of account numbering, but all will follow some similar kind of arrangement, encoding of transactions. A sales ledger is a detailed itemization of sales made, presented in date sequence. It may also contain credits issued that reduce the amount of sales, perhaps for products returned by customers. The information in a sales ledger can be quite detailed, including such items as the sale date, invoice number, customer name, items sold, sale amounts, freight charged, sales taxes, value-added tax, and more. The information in a sales ledger is summarized periodically, and the aggregated amounts are then posted to the sales accounts in the general ledger. This posting can be as infrequent as the end of each month, as part of the month-end closing process, or even every day. The detail-level information in the sales ledger is kept separate from the general ledger, in order to keep the general ledger from being overwhelmed with too much information. The following are examples of how a sales ledger can be used. Financial statements. The sales ledger is the ultimate source document for the sales figure that appears at the top of the income statement. Research. If someone wants to research a sales issue, they typically begin with a high-level analysis in the general ledger, such as a trend line analysis, and then switch to the sales ledger to determine the details of exactly what happened. Auditing. An auditor will likely want to ensure that the total sales amount reported in a company's financial statements is correct, and will investigate by examining a selection of the invoices listed in the sales ledger, which comprise that sales figure. Originally, the sales ledger was manually maintained, with postings to the general ledger also being completed by hand. With the advent of computerized accounting systems, it is not always apparent that a sales ledger exists, since a user simply searches for a specific invoice number, date range, or amount, and never realizes that he or she is accessing what used to be called the sales ledger. Thus, the term is less commonly used than had previously been the case. The sales ledger is frequently in software known as accounts receivable or customer accounts. The sales ledger is your record of sales, and whether or not you have received the money, and how much you are still owed. On the balance sheet, the total amount still owed to you by customers will usually be called trade debtors or accounts receivable. The sales ledger has an account for every customer. Each such customer account carries all the transactions for the one customer. These are sales invoices, sales credit notes, and payments received. In accounting software, by recording these three types of transactions, you will get an immediate calculation of the money owed to you. The accounting software will also allow you to allocate or apply the money received to the sales invoice it relates to. These transactions are then regarded as cleared. If you run an open items or unpaid invoices report, you will see just the unpaid invoices, rather than all the previous paid invoices, which is usually a much bigger report and not frequently needed. If trading is healthy, many of the customer accounts will be carrying balances at any given time, hopefully just the most recent unpaid sales invoices. As with all accounts and ledgers, the transactions will be recorded as debits and credits. To make the accounting records complete, the sales ledger has to be represented in the general ledger, even though they themselves are separate ledgers. This is achieved by the concept of control accounts. On the general ledger, there will be a control account for the sales ledger. Every time a transaction is recorded in the sales ledger, for example, sales invoice, an identical record is kept in the sales ledger control account on the general ledger. This is the way that the general ledger stays in balance. The purchase ledger is a subledger in which purchases are recorded. The purchase ledger is part of the accounting department's database. It is not maintained by the purchasing department. The ledger is useful for segregating into one location a record of the amounts a company spends with its suppliers. The purchase ledger shows which purchases have been paid for and which purchases remain outstanding. A typical transaction entered into the purchase ledger will record an account payable, followed at a later date by a payment transaction that eliminates the account payable. Thus, there is likely to be an outstanding account payable balance in the ledger at any time. The data fields in a manually prepared purchase ledger might include the following information for each transaction: purchase date, supplier code or name, supplier invoice number, purchase order number if used, identifying code for the item purchased, amount paid, sales tax paid, and payment flag, which states whether paid or not. The primary document recorded in the purchase ledger is the supplier invoice. Also, if suppliers grant a credit back to the business for such items as returned goods or items damaged in transit, then you also record credit memos issued by suppliers in the purchase ledger. The purchase ledger is your record of your purchases and expenses, whether or not you have paid them, and how much you still owe. On a balance sheet, the total unpaid bills will be called trade creditors or accounts payable. The purchase ledger has an account for every supplier. Such a supplier account carries all the transactions for the one supplier, including purchase invoices, purchase credit notes, and payments made. In accounting software, by recording these three types of transactions, you will get an immediate calculation of how much money you owe to other people and businesses. The accounting software will also allow you to allocate or apply the money paid. to the bill it relates to. These are then regarded as cleared. Then if you run an open items or unpaid bills report, you will see just the unpaid bills, rather than all the previous paid bills, which is usually a much bigger report, and not frequently needed. If trading is healthy, many of the supplier accounts will be carrying the balances which you owe at any given time, usually just the most recent unpaid purchase invoices. As with all accounts and ledgers, the transactions will be recorded in debits and credits. The information in the purchase ledger is aggregated periodically and posted to an account in the general ledger, which is known as a control account. The purchase ledger control account is used to keep from cluttering up the general ledger with the massive amount of information that is typically stored in the purchase ledger. Immediately after posting, the balance in the control account should match the balance in the purchase ledger. Before closing the books and generating financial statements at the end of an accounting period, you must complete all entries in the purchase ledger, close the ledger for that period, and post the totals from the purchase ledger to the general ledger. You've probably heard the term general ledger, and might even have joked that this must be the guy who secretly runs accounting and issues all those reports no one can read. The general ledger is a place where all accounting transactions ultimately come to rest. It is also the data source for most of the basic financial statements that companies produce. A chart of accounts is a systematic list of all ledger account names and associated numbers used by a company, arranged in the order in which they normally appear in financial statements: customarily assets, liabilities, owner's equity or stockholders' equity, revenue, and expenses. You might think of the general ledger as a large, old-fashioned scale that is always kept in balance because its keepers always add or subtract an equal and offsetting amount of weight to each side whenever they record something. All of the buckets that appear in the chart of accounts are arranged in one or the other of the trays, depending on the account number on the bucket. We have seen that bookkeeping is a critical activity for any business, small or large. Bookkeeping uses the double entry system. The double entry system has two equal and corresponding sides, known as debit and credit. There are three categories of books: the sales ledger, which deals mostly with the accounts receivable account. This ledger consists of the financial transactions made by customers to the business. The purchase ledger is a ledger that goes hand in hand with the accounts payable account. This is the purchasing transaction a company does. The general ledger representing the original 5 main accounts: assets, liabilities, equity, income, and expenses. Finally, the chart of accounts is used by the accounting software to aggregate information into an entity's financial statements. There are a number of activities to complete for this unit. Take the time to complete these in your manual. In this way, you will better learn from and retain the knowledge covered in this unit. Many thanks for watching this lesson. Want to learn more? Click on our website to view our range of courses on financial management.